Australians are waking up to a shocking reality. Your bank does not need your permission to suddenly close or freeze your account. And for many seniors, this could mean delayed bills, blocked pension access, or losing access to hard-earned savings overnight. In this video, I'll reveal the warning signs banks don't openly talk about, the mistakes that put age pension payments at risk, and the urgent steps every Australian over 60 must take right now to protect their money before it's too late. Stay until the end because I'll also share the latest age pension payment updates, pension crisis alerts, and new banking changes affecting retirees across Australia in 2026. Subscribe now and join our community made especially for Australian seniors, pensioners, and everyday retirees who want real updates, protection, and financial security before the next major change hits. Imagine waking up one morning, reaching for your phone to pay for your morning coffee, and your card gets declined. You check your banking app, and instead of your balance, you see a message that stops your heart. Your account has been closed. No warning, no phone call, no letter, just gone. And here is the part that will really shake you. Your bank did absolutely nothing illegal. In Australia, your bank has the legal right to close your account at any time for almost any reason. And in most cases, they do not need your permission, your agreement, or even a satisfying explanation. This is not a loophole. This is not a glitch in the system. This is written into the very terms and conditions you agreed to when you signed up, probably without reading them and probably years ago. This is happening to real Australians right now. It happened to a small business owner in Melbourne who had banked with the same institution for over 15 years. One day, he received a brief letter informing him that his business accounts would be closed within 30 days. No reason was given. His payroll system, his supplier payments, his ATO obligations, all of it suddenly hanging by a thread. It has happened to charity workers, to migrants sending money home to their families, to retirees who have never missed a payment in their lives. Account closures in Australia have been quietly rising, and most people have no idea it can happen to them until it does. So why does this happen? The answer lies in a practice the banking industry calls de-risking. After years of intense regulatory pressure following money laundering scandals, Royal Commission findings, and global compliance crackdowns, Australian banks have become extraordinarily cautious about who they choose to do business with. Under anti-money laundering and counter-terrorism financing laws administered by AUSTRAC, banks are legally required to monitor customer transactions and report suspicious activity. The problem is that the cost and complexity of monitoring certain types of customers, particularly those who send money overseas, run cash-heavy businesses, deal in cryptocurrency, or operate in industries the banks have quietly decided are too complicated, has led many institutions to simply exit those relationships altogether. It is cheaper and safer from the bank's perspective to close an account than to manage the compliance risk that comes with it. And so they do. What makes this even more unsettling is how little notice you are typically given. Under the Banking Code of Practice, which is the industry's own voluntary standard, banks are generally required to give you at least 30 days notice before closing your account. But there are exceptions carved out so wide you could drive a truck through them. If the bank suspects fraud, financial crime, or a breach of terms and conditions, they can act immediately. If they believe giving you notice would somehow interfere with their legal obligations, they can skip it entirely. And here is the thing. They rarely have to tell you which exception applies. You might receive a short, vague letter citing a broad policy review. You might get a form email. In some cases, people have reported discovering their account was closed only when they tried to make a transaction. The bank is under no legal obligation to give you a reason, and in practice, most do not. Now, here is where it gets legally and practically complicated. The money in your account is yours. That is non-negotiable. If your bank closes your account, they are required to return your funds, and they cannot simply hold on to it indefinitely. But how they return it and how long it takes can create real hardship. If you have direct debits coming out of that account, rent, mortgage repayments, insurance premiums, utility bills, those payments will bounce the moment the account is closed. Late fees will accumulate. Your credit rating can be affected. If you are a business owner, your relationships with suppliers who depend on timely payments can be damaged in ways that take months to repair. And if you are in the middle of a property settlement, a large investment, or any time-sensitive financial transaction, an unexpected account closure can cause cascading consequences that go far beyond inconvenience. There is also a dimension to this story that does not get talked about enough, and that is the experience of communities who are disproportionately affected. Migrants and refugees in Australia face a significantly higher rate of account closures and refusals, particularly those who use remittance services to send money to family in countries flagged as high-risk jurisdictions. The assumption embedded in the bank's risk algorithms, that certain nationalities, certain transaction patterns, or certain occupations are inherently more suspicious, has real human consequences. It is not always the result of deliberate discrimination, but the outcome is discriminatory regardless of intent. Sex workers, legal cannabis businesses in states where it is regulated, and even some religious organizations have reported having accounts closed because the bank quietly decided the reputational or compliance risk was not worth it. These are legal activities. These are law-abiding Australians. And yet they are being pushed out of the banking system through a process that has almost no external oversight. So what can you actually do? Let us start with the most important thing, and that is preparation, because the best protection against an account closure is to make sure one never catches you off guard. If you have all of your financial life sitting in a single account at a single bank, you are exposed. The single most powerful thing you can do right now, today, before anything else in this video, is to open a secondary account at a different institution. It does not need to be your primary account. It just needs to exist, to be active, and to have enough of a transaction history that if your main bank ever closes your account, you have somewhere to land immediately. Mutual banks, credit unions, and smaller authorized deposit-taking institutions are worth considering because they often have a different risk appetite and a more relationship-driven approach to their customers than the major banks do. Neobanks and fintechs can also serve as useful backup options, though it is worth noting that they are subject to the same regulatory framework and can also close accounts without warning. The second thing you need to do is read your terms and conditions. I know that sounds like the most boring advice in the world, but it is genuinely important. Buried in your account agreement is a clause that gives the bank the right to terminate the relationship. Understanding what triggers that clause, what kinds of transactions, what account activities, what changes in your personal circumstances, can help you avoid inadvertently tripping it. If you run a business, pay particular attention to whether your business account and personal account are governed by different terms. Many business banking agreements have even broader termination clauses than personal accounts, and the consequences of losing a business account are usually far more severe. The third thing is to understand the complaint and escalation process. If your bank closes your account or notifies you that it intends to, you have options. The first step is always to contact the bank directly and ask for a formal review. Do this in writing. Request that they provide the specific reason for the closure and ask whether there are any conditions under which the decision could be reversed. Banks are often unwilling to provide detailed explanations, but asking creates a paper trail. If you are not satisfied with the bank's response, or if they refuse to engage meaningfully, you can lodge a complaint with the Australian Financial Complaints Authority, known as AFCA. AFCA is an independent dispute resolution body that handles complaints against banks and other financial institutions. They can investigate your case, require the bank to provide more information, and, in some cases, order the bank to reverse a decision or pay compensation. AFCA's service is free, it is independent, and it has real authority. The bank is required by law to be a member and to participate in AFCA's processes. What AFCA cannot always do, however, is force a bank to maintain a relationship it has decided to exit. The legal framework in Australia currently gives banks significant discretion over who they choose to serve, and AFCA's powers in this specific area have limits. This is a policy gap that has been identified by consumer advocates, academics, and even some regulators, and there is an ongoing conversation about whether Australia should move toward a model where access to basic banking services is treated more like a right than a privilege. Several countries, including the United Kingdom, have introduced a basic bank account regime that requires banks to offer a no-frills account to virtually anyone, regardless of risk profile. Australia does not yet have an equivalent, though the debate is gaining momentum, and it is worth watching. In the meantime, documentation is your greatest ally. If you operate a business, a charity, or work in an industry that banks sometimes view as high risk, maintain clear and organized records that demonstrate the legitimacy of your transactions. This includes invoices, contracts, bank statements from previous periods, and any correspondence with regulatory bodies. If your bank ever questions a transaction or asks you to explain your account activity, respond promptly, provide the documentation they ask for, and keep a copy of everything you send. Banks make risk decisions partly based on how transparent and cooperative a customer is. Being responsive and well-documented can sometimes be the difference between a relationship that is maintained and one that is terminated. If you are notified that your account will be closed, act fast on a few critical fronts. Contact every organization that pays money into your account. Your employer, the ATO, Centrelink if applicable, clients, tenants, and update your bank details immediately. Cancel or transfer every direct debit. This is the part that trips people up the most, because direct debits are easy to forget about until they fail. Go through your last 12 months of statements and identify every single recurring payment. Then contact the relevant providers and update your payment details before the closure date. Do not assume anything will transfer automatically, because it will not. There is also a question of your credit file that is worth addressing. A bank closing your account does not automatically damage your credit score in the same way a loan default does, but it can have indirect effects. If direct debits bounce and lead to missed payments on utilities or insurance, those providers may report the default. If you end up overdrawn in the process of the account being closed and the bank pursues the debt, that could affect your credit report. Monitoring your credit file through services like Equifax, Experian, or Ilion, all of which offer free annual credit reports, is a sensible habit regardless of whether you are facing an account closure. Finally, there is a bigger conversation that this issue demands, and it is about what kind of banking system Australians deserve. Banks in this country are not purely private entities making purely private decisions. They are licensed by the government. They operate under a framework of laws and regulations that the public funds and maintains. They benefit from an implicit government guarantee that gives Australians confidence in depositing their money. In exchange for those privileges, there is a legitimate argument that banks carry a social obligation, not just to their shareholders, but to the community they serve. When banks systematically exclude certain groups from access to financial services, even when those groups are doing nothing illegal, it undermines social participation, economic opportunity, and trust in the financial system itself. The conversation happening right now in Australia around banking access, de-risking, and consumer rights is one that will matter for years to come. Advocacy organizations like the Consumer Action Law Center and Financial Rights Legal Center are doing important work in this space. And if this issue affects you or someone you know, connecting with them can provide both practical assistance and the power of collective voice. Because ultimately, the most effective protection against unfair treatment by financial institutions is not just individual preparation. It is a regulatory environment that takes access to banking seriously as a public interest matter, not just a commercial one. Until that day arrives, the best thing you can do is be informed, be prepared, and never assume your bank account will always be there in the morning.